Hello and welcome to Every Quarter. So, as an investor, one of the things that you need to do is that you need to adopt and execute a very definite investment strategy. Okay, and in this episode, I would want to share with you a snippet from a podcast that I was watching last week featuring Morgan Housel. Morgan Housel is the author of one of the most popular books nowadays, The Psychology of Money, Timeless Lessons on Wealth, Greed, and Happiness. This is one of the most happening books of our time. And it was authored by one Morgan Housel, who featured on this podcast, The Diary of a CEO. And in this episode, he talks about a lot of things concerning personal finance. And one of the things that he does is share with us his investment strategy. And so let me just play this clip. Let's listen into what Morgan Housel's investment strategy is.
What is your capital allocation strategy? How do you invest your money? This is the thing people want to know most about you.
I keep it as painfully simple as I possibly can. So literally my entire net worth is cash, a house, and index funds, and some shares of Markel where I'm on the board of directors. And that's it. There's nothing else. I can summarize everything so easily and so cleanly. And truly, that's it. And it's not even like I have 20 bank accounts. I have one bank account, one brokerage account, and a house, and that's it. So simple.
Why index funds?
So what you see is a man who has adopted a definite investment strategy. He will not be tossed to and fro by every wind of investment doctrine. He is someone who knows exactly what they are doing, and they stick to it. Let's listen.
You're the reason your capital allocation strategy is almost identical to mine. I want to talk about the house thing as well, but after reading your book, I stopped trying to pick stocks.
Yeah.
And I invested all of my available capital into index funds outside of investing it in starting companies. So I'm a shareholder in, 50, 60, 70 companies. All my other available capital is invested in index funds. And then I have a very long-standing large position in Ethereum, which I've held for like 6 years or something.
Yeah.
Now, which has done me very well.
Yeah.
That is it. And the Ethereum investment is also based on the fact that I run a software business that is in blockchain. And I could see that developers are building on top of Ethereum more than any other blockchain. So that insight was really beneficial to me.
And 6 years, so even with the big fall over the last 2 years, you're still up a lot.
Yeah, I think your book taught me that successful investing is when you lose the password to your investment account.
Yes, that's exactly it.
I don't actually think you said that in there, but that's like, when I lose the password to my investment account, I'm so proud of myself.
Yeah.
Because it means I haven't checked it in forever. And so it was funny because you were coming today. I thought, oh yeah, well, I have all this money in these index funds. I'll check it. And I thought, fuck, I don't know the password.
Good. That's why you're going to do okay. The reason I do this, what's important is that I am not one of the people who says nobody can beat the market, so therefore use index funds. That's not what I believe. I think it's extremely hard to beat the market, and very few people will do it. But I think there are really smart people who can do it, and people who I know who I could invest with. The reason I don't is not because I don't believe it can be done. It's because the variable that I want to maximize for in my investments is endurance. If I can just earn average returns for an above average period of time, it's going to lead to an amount of success that will literally put you in the top 5% of investors. My parents are a great example of this. My parents are smart people, but they have no financial background. And they have like minimal financial interest, I would say. But they have dollar cost average into index funds for going on 40 years now. And literally, if you look at the returns, they've never sold anything ever. And literally, if you look at the returns, they'd probably be in the top 3% of professional investors.
For anyone that doesn't know, what is dollar cost averaging and what is an index fund?
Dollar cost averaging means you buy the same dollar amount of investments every single month, come hell or high water. Doesn't matter what the stock market's doing, recession, boom, bust, you say, I'm going to put $100 or whatever it is in the stock market on the first of every month. Now, most people who have a 401k at work are doing this whether they know it or not. They have $100 or whatever removed from every paycheck, and it goes into the funds that they own, and they don't have to do anything. Whether you know it or not, you're actually doing it. The contrast to that would say, I'm going to buy and sell based off of how I feel in the stock market. I wake up, I watch CNBC, I decided to sell, and I'm going to put it back in when I feel better about the market. It's the contrast to that. An index fund is just a single fund that owns hundreds or thousands of stocks within it. And if it's diverse enough, if it's big enough, really what you're doing is you're owning a slice of the global economy, which is how I think about it. It's thousands of individual stocks in there, Tesla, Apple, whatever it be. But really what you're doing is you're owning a slice of capitalism.
If I was your son and I said, Dad, prove to me that that's a better long-term wealth creation strategy than buying crypto or buying companies that I use or like, how would you explain that to your kid?
Your ability to do well over the next 1 year or 5 years is going to have no role whatsoever on your lifetime ability to generate wealth. All that's going to matter is not what are the best returns you can earn. All that matters is what are the returns that you can sustain for the longest period of time. All that matters is your endurance. It doesn't matter if you can double your money this year or even double your money again the next year. All that matters is, can you stick and keep it going for 50 years? That's where compounding comes from.
Prove it.
Because the formula for compounding is returns to the power of time. That's not quite it, but more or less that's it. So in that equation, if you understand the math, all of the heavy lifting comes from the exponent.
Prove it.
Because that's how exponential growth works. That's how it works. It's literally exponential.
Give me a case study where someone has followed that strategy and done well.
Okay, here's one way to explain it that I use in the book. 99% of Warren Buffett's net worth was accumulated after his 60th birthday. After he turned 60 years old, 99% of his wealth has been accumulated after that period. Because the longer you hold that for, the crazier the numbers get. When he was 60, I think he was worth about $3 billion. A lot of money. He's a multi-billionaire. But now that he's 90, he's worth over $100 billion. And he's given $100 billion away to charity. So if he didn't do that, he'd go from $3 billion to $200 billion since he's been 60. Because the numbers just get crazier at that point. He's worth $100 billion. So if his net worth goes up 10% in 1 year, he makes $10 billion, which is 3 times that he was worth when he was 60. So that's when you look at somebody like Buffett, is he a great investor? Is he a great stock picker? Of course. But the real secret to his success is that he's been a good investor for 80 years. And if he had retired at age 60 or at age 50, nobody would have ever heard of him. He would have been like one of the other multi-billionaires who lives in Florida and plays golf, and you've never heard of him. The reason he's a household name is because he's been doing this nonstop since he's been 11 years old, and he's never stopped. It's just the endurance that's made him so wealthy.
Okay, so there you have it. A snippet of this long podcast, almost 2 hours long, filled with lots and lots of personal finance gems that would benefit you as an individual. I just thought I needed to share this particular snippet to do with Morgan Housel's investment strategy. I hope that even as we embark on your investment journey, you have a very particular strategy that you stick to and implement it, and basically see yourself moving in the direction that you desire to move in. Obviously, there's an opportunity to learn. You can adopt one strategy at a particular time, and as you gain experience, adjust in keeping with the new information that you're changing. But at any particular point, you need a particular strategy that you should be implementing. And we've just heard from someone we can all look up to what his investment strategy is. Until next time, it's a pleasant evening from me.